A few decades back, mostly everyone simply parked their money in fixed deposits and government schemes like the EPF, PPF, and NSE. Even my parents and relatives, in fact, everyone I knew, had almost all their money either in gold or a fixed deposit with a trusted bank. It is safe to say that the previous generations put more importance on safety and security than high returns. However, with the changing business, social, and economic environment, most of us prefer investing in equity and other high return investments. And in our defense, rising inflation, lower interest rates, and higher cost of living have resulted in the need for high returns. Hi, I am Vaibhav Porwal and welcome to channel Dezerv. In this video, we are going to talk about bonds. In the past 2 years, most investors have gravitated towards equity and other growth assets. However, let us not forget that debt and fixed income investments are equally important in the portfolio. So when we build portfolios for our clients, we ensure diversification across asset classes and across different risk exposures. One important instrument in the debt space is bonds. And in this video, I am going to talk about bonds and what investors like you and me should keep in mind when investing in bonds. Bonds are a type of fixed income instrument issued by governments or institutions. If a government or institution requires money for a fixed purpose or project, it issues bonds to investors to raise money. In essence, a bond is a loan given by the investors to the entity. Like in any loan, the investor regularly gets a decided interest and at maturity gets back the principal amount as well. Thus, bonds have a fixed interest component and fixed maturity date. People choose to invest in bonds because they feel it is safer, involves less risk than equity investments, and provides them regular interest income. There are various options for Indian investors when it comes to bonds, like public sector undertaking or PSU bonds, corporate bonds, tax-free bonds, zero coupon bonds, convertible bonds, sovereign gold bonds, perpetual bonds, and many more. As someone who has been there in the financial services industry for almost 20 years, even I find the multiple options confusing. Hence, when we built Dezerv, one of our goals was to help people understand bonds and assess if they should invest in bonds and how to go about it. Do get in touch with us if you have any questions on how to select a bond to invest in. As you saw above, there are many types of bonds. Investors mostly focus only on the interest they are receiving and are leaning more towards high yield bonds. High yield bonds are bonds that offer higher returns compared to fixed income instruments. The consistently low real rate of returns of traditional debt instruments has facilitated the growth of the high yield debt market. But like the common investment mantra, high returns involve high risk. High yield bonds come with high risk. Now let's be upfront. Debt investments are there in your portfolio for safety, security, and stability. What is the point of a debt investment if you're going to have sleepless nights about your investments? Thus, before you jump to invest in high yield bonds, let's understand what are the risks you may face and how to manage them. Now, I am going to tell you a few points to keep in mind before choosing a bond to invest in. Consider all your requirements. Don't focus only on the interest that you will receive. Consider the following: your risk appetite, your tax saving requirement, lock-in period that you are okay with, how easily you can sell the bonds before maturity if required, all associated costs with investing in bonds, secured versus unsecured bonds. Bonds that are issued with collateral are called secured bonds. Because the collateral reduces the investor's risk, it is advisable to opt for secured bonds. You should avoid investing in unsecured bonds where the risk is much higher. Specific versus general collateral. Secured bonds can be secured against a particular asset or the whole balance sheet of the entity issuing the bond. In bad times, it is easier to enforce liquidating specific assets versus liquidating the entire company. Thus, as an investor, you will face less risk if you choose a bond that is secured against a specific collateral. Cash flow of the borrower. You should look at the borrower's cash flow to assess their ability to repay, because even if the bond is secured, enforcement of collateral is not an ideal scenario. Thus, a borrower that has a good track record and management to facilitate seamless operations and income will be less likely to default on repayment. So do not rely only on the rating given by credit rating agencies, and look into the cash flows, integrity and background of management and the core business of the borrower. These are few of the things to keep in mind while choosing a bond. In conclusion, I would like to say that don't get swayed by high yields. While high yield bonds seem very appealing and can play a role in your portfolio, ensure that investments are made with adequate safeguards and form a small part of the portfolio. Hope you found this video useful, and if you have any questions, please put them down in the comments below and my team and I will address them for you. Hit the subscribe button below and press the bell icon for our latest videos. Thank you.